All right. Moving on to from AGI deductions. So we start with medical expenses. Understand that medical expenses are deductible. Well, again, all of your itemized deductions have to be, if you're married filing jointly, greater than $24,000 in 2018 for you to even utilize them. And you put all your itemized deductions on Schedule A. If you look at page 23 of Chapter 6, Exhibit 6-9, you see that on Schedule A, the first thing you have there is medical and dental expenses. So note here, in this example, they have 38,330. So all of your itemized deductions have to be greater than whatever the standard deduction is. If you're single, it's 12,000. And so when we talk about these separate itemized deductions, just realize that the sum of all itemized deductions has to be greater than the standard deduction for you to even use these. All right. So having said all that, back to medical expenses. All right. So the purpose of this is to provide some relief to taxpayers who are strapped financially because they're having to dole out of their own pocket uh, a substantial amount for health-related expenses. So you've got to have some pretty substantial expenses, and you'll see why here in a second, in order to even utilize any of your health-related expenses. All right, so let's talk about general. What does it take to even qualify? Well, it's it's got to be incurred to treat either the taxpayer, taxpayer's spouse, or dependents. It's got to be related to expenses that are incurred for the care, prevention, diagnosis, or cure of an injury, disease, or bodily function, and these expenses cannot be reimbursed by health insurance and or not paid by a flexible spending account, FSA. And so, some common expenses they mention: prescriptions, medical aids such as glasses or contacts, wheelchairs. What about your Tylenol? Well, no, that's an over-the-counter drug. You can't deduct that. Payments to health providers, doctors, PAs, uh, hospitals, healthcare or medical care facilities, other medical care facilities other than hospitals, such as long-term care facilities, transportation for medical purposes, as well uh, as you will see, overnight stays, as well as, well, it does not include the cost of meals, but it does include lodging for transportation, as well as transportation if it's related to medical care. So you have to go to Mayo Clinic in Rochester, Minnesota. You take a jet. I guess you could drive. If you drive, you get 18 cents a mile in lieu or actual expenses. Question is, it says taxpayers using personal automobiles may deduct standard mileage. What about the jet? Just says taxpayers traveling for the primary purpose of receiving essential and deductible medical care may deduct the cost of lodging while away and transportation. Doesn't say you couldn't deduct the cost of your flight. Just says that if you use an automobile, you may use either the standard mileage allowance of 18 cents per mile or actual cost. Long-term care facilities and health insurance premiums, if you actually pay those, and insurance for long-term care services. What about medical expenses if they are for something, you're just not happy with your looks? You need a little nip and tuck in your face. Is that covered? Well, no, that's not covered. Number one, it's um, elective. The only way cosmetic surgery is covered, the cost, is if it's meant to fix a deformity, directly related to some sort of congenital abnormality, a personal injury resulting from an accident or trauma, or some disfiguring disease. Usually medical expenses, you get into stuff like, well, I went to my doctor. He says I'm under too much stress at work. He wants me to take a relaxing cruise to see if I can get my blood pressure down. Is that covered? Well, no, that's not covered. What if you have debilitating arthritis and your doctor prescribes um, swimming for you? So you build a pool. Yeah, that's actually covered, but it's only covered to the extent that it doesn't increase the value in your property overall. For whoa, for hospitals and long-term care facilities,
you can deduct the cost of meals and lodging. If it's a long-term care facility, though, the principal purpose for the stay must be medical care rather than convenience. Notice there's an example here, infertility. Well, are infertility treatments deductible? And the answer is yes. Why? Because you're trying to cure a bodily function, I suppose. If you're infertile and you're trying to get pregnant, it's no different than, well, I can't see. I need glasses or contacts or both. All right, so much for medical expenses. So before you can even start to talk about whether medical expenses are deductible, just realize that medical expenses have to be above a certain amount before you can even use them as part of your, to include with all your other itemized deductions on Schedule A. So your medical expenses have to be greater than 7.5% of AGI. And so the excess amount over 7.5% of your AGI is the amount that you write on Schedule A. So let's take a taxpayer whose AGI is $100,000. Well, if they have medical expenses, they're only going to write down those medical expenses. They're greater than 7.5% of $100,000 on Schedule A. So what is that? That's $7,500. They've got to have in excess of $7,500. Let's say they have $10,000 in unreimbursed medical expenses. Well, they take the $10,000, subtract 7.5% of $100,000, $7,500. So they would be able to utilize $2,500 of medical expenses toward itemized deductions in determining whether or not they've got more itemized deductions than they do standard deductions. So as the book points out, you've got to have some pretty substantial unreimbursed medical expenses to qualify for this, to be able to even utilize any of this. And there's some examples in the book as well. Example 6- 12 and 13. No, just 12. Taxes. You can deduct taxes paid other than federal taxes. And so this includes state, local, and foreign income taxes, including state and local taxes paid during the year through employer holding, estimated tax payments, and overpayments on prior year returns that the taxpayer applies to the current year, state and local real estate taxes on property held for personal or investment purposes, and state and local property taxes assessed on the value of specific property. In lieu of the state and local income tax deduction, the taxpayer can elect to deduct state and local sales taxes. So if you live in a state that doesn't have an income tax, state and local income tax, state and or local income tax, and it's usually just the state, then you can elect to deduct state and local sales taxes. So in Oregon, you've got a state income tax, a pretty good one too. Not quite California, but still pretty high. But you don't have a sales tax, so you're going to use state income tax there. Now, understand that when you deduct this from AGI, you are limited to $10,000 if you're married filing jointly, single, well, basically for everybody except married filing separately. In that case, you're limited to a $5,000 itemized deduction for payment of state, local, and foreign income tax, real property tax, personal property tax. So if you cover the news, any hot states where there's a high income tax, those state governments are up in arms over the fact that no longer can you deduct all of the state income tax paid as an itemized deduction. The new tax bill limits it to $10,000. And so for, if you're fairly well off, you're paying a hell of a lot more than $10,000 in state income tax. Now you can't deduct any excess over $10,000. So tough luck for them. Interest expense. And so here you have two itemized deductions. You have deduction for investment interest. Remember, I talked about the fact that to purchase stock, you might borrow money to purchase the stock. If you borrow money to purchase stock, you're going to pay interest on that. And so you're limited in the amount of your deduction of investment interest to whatever the amount of investment income is. And any excess carries forward to subsequent years. The big one, and usually that's not a lot of money, but I guess it could be, but not very many people utilize that. The biggie is home mortgage interest deduction. And so the amount of interest that you can deduct depends on the amount of acquisition indebtedness the taxpayer has and when they acquired the acquisition indebtedness. Well, first of all, what's acquisition indebtedness? Well, it's essentially when you purchase a property, and this is for the, let me mention this. This is for the acquisition of the taxpayer's principal residence and one other residence. Okay. So, and most people, it's just their principal residence. Most people don't have a second residence. So, but some do. And so, what is acquisition indebtedness? Well, it's debt that's used to pay for the principal residence. And in return, the principal residence secures the debt. All right, so that's acquisition indebtedness. The amount of interest you can deduct depends on the amount of the acquisition indebtedness and when you incurred it. If you incurred the acquisition indebtedness before December 15, 2017, you can deduct acquisition indebtedness, interest on acquisition indebtedness, if the acquisition indebtedness is $1 million or less. Okay, so you don't get to deduct $1 million, you just get to deduct the interest that's paid on acquisition indebtedness to the extent that it doesn't exceed $1 million. If the acquisition indebtedness was incurred on or after December 15, 2017, then the interest on acquisition indebtedness is limited to $750,000. And they don't even give an example, but but they do in the book. So here you have this individual who acquired her home for $300,000. She paid $40,000 down payment and borrowed $260,000. And of course, she secured the loan by using the home as collateral for the loan. So the home secures the loan. During the year, she paid $15,800 in interest on the loan. How much of that interest may she deduct? Well, the acquisition indebtedness is $260,000. It was acquired in January of 2018, so she's subject to the $750,000 of acquisition indebtedness. Well, her $260,000 loan is less than $750,000, so all of the $15,800 is allowed to be used as an itemized deduction on Schedule A. Now, what would happen if you have excess in amounts of acquisition indebtedness? You would simply take the amount of interest paid and multiply it by, okay, let's say it was incurred after December 15, 2017. Let's say the acquisition indebtedness was $1 million. And of course, you're only you're limited to the amount of interest on acquisition indebtedness up to $750,000 of acquisition indebtedness. So what you would do, let's say you paid $20,000 of interest for the year. What you would do is you'd take that 20,000 and multiply that times the limit, $750,000. Divide that, so that's going to be your numerator, the 750, and you're going to divide that into the total acquisition indebtedness of $1 million. So nice, easy example. Well, 750 of 1 million is 3/4, right? So in this case, the taxpayer would be able to deduct 3/4 of the $20,000 or $15,000. So that's how you do that calculation when the acquisition indebtedness is greater than the limit here. Charitable contributions, most people give something at some point in their life to a charitable organization or governmental entity. There are limits, but the limits are usually really high. So it depends on how much you give and depends on whether or not you're giving money or other property. And so special rules apply to charitable contributions of property depending on the type of property. First of all, if you're giving money, you can give up to 60% of your adjusted gross income and be able to deduct that amount. Well, that's a lot, right? If your AGI is $100,000 and you give 10,000 of that to a qualifying charity, well, that's less than 60% of AGI by quite a bit, right? That's $60,000, so no problem there. You put $10,000 on your Schedule A as a charitable contribution. For capital gain property, I think we know what that is by now, but it has to be long-term capital gain property. You're allowed to deduct the fair market value, but you're limited to 30% of your AGI. So there you might run into a problem. Especially if it's appreciated quite a bit. To complicate things even more, if you give your charitable contribution to a public charity or private operating foundation, you get those limitations. Also, if it's ordinary income property, not capital gain property or cash, the amount that you can show as being given is the lesser of the property's basis or its fair market value. There, your AGI limit is 50% for a public charity and private operating foundation. If it's a private non-operating foundation, different numbers. For cash, it's still the cash amount, but you're limited to 30% of AGI. Capital gain property, there you get to deduct the basis, not the fair market value. But fair market value if you're contributing stock and it's publicly traded stock. Your AGI limit there is 20%. And for ordinary income, also the amount that you would record is the lesser of basis or fair market value, and the AGI limit is 30%. And so it gives you this 4-step process that you have to do on page 19. And there's some examples in the book as well. So you start with your cash contributions, your 60% contributions. Next, you apply limitation to the 50% contributions. And again, you have to subtract the contribution subject to the 60% limit from your contributions in the 50% category. It's just a mess. So look at these examples in here. Used to, back in the old days, meaning last year and before, you could deduct a certain amount of casualty and theft losses on personal use assets. Well, that's gone away with this new tax bill. So we don't have to talk about it. Also, Congress has gotten rid of most miscellaneous itemized deductions. Used to, there was a slew of them. Not anymore. Unreimbursed employee business expenses, tax preparation fees, investment expenses, and hobby expenses used to all be deductible miscellaneous itemized deductions subject to a 2% of AGI floor. Well, not anymore. So basically, all you get to deduct as an itemized deduction, subject to the 2% floor, I assume, is gambling losses. Also, casualty and theft losses on property held for investment, not personal use, are deductible as an itemized deduction, subject to the 2% floor, I assume. Let me look. Yeah, 2%. Line 26 of Schedule A. All right, let's talk about the standard deduction. Standard deduction, as you know, is 24,000 married filing jointly. Household head of household 18, single and married filing separately 12. Now, if you are 65 or older and or blind, legally blind, you get additional standard deductions. If you are both 65 and blind, you get both additional standard deductions. So if you're married filing jointly and both of you are 65 and blind, 65 or older and blind, both of you, you would get the 24,000 standard deduction plus $5,200, 1,300 times 4 additional. So 29,200 standard deduction amount. And so, if you're head of household or single, it's 1,600 additional standard deduction for age, 65 or older, and or blindness. And for married filing separately, 1,300 for each of those. They talk about, rather than piecing out various itemized deductions over several years, you might want to have as a strategy of bunching your itemized deductions in a particular year so that it makes your itemized deductions greater than the standard deduction. Sometimes that's not possible though, but it's certainly an option to look at. All right, so we're not going to talk about the qualified business income deduction. So that's the end of chapter 6 lecture.